My name is Peter Zomick. I am the Vice President of Sales and Business Development for Arrival Home Loans. And Arrival Home Loans offers residential consumer bridge loans in 10 states currently and plans to be in about 20 by the end of this year. Uh, we are owned by Pacific Private Money, which is a private lender that focuses on alternative financing in the business purpose space, headed out of Novato, California. They've been in business since 2008. One of the products they have offered since about 2010 is this consumer bridge loan that we're going to be talking about today. So this is not kind of a new product, but about 2 years ago, Pacific Private Money spun off a DBA and created Arrival Home Loans to really focus on the scaling, growth, and branding of a much needed product out in the marketplace, not only today with high interest rates and limited inventory, but when the market turns, this product and solution is going to be even more important than it is today. So Arrival Home Loans does consumer bridge loans. That's all we do. We don't do any type of other financing. We don't do conventional, FHA, jumbo, VA, non-QM. All we do is bridge loans. And that's important because a lot of the process of paying off our bridge loan involves another mortgage. And so that gives our wholesale partners and their loan officers an opportunity to get a second transaction from the buying process. So they get the purchase, which they get compensated on with the wholesale partnership with Arrival, but then they get paid again when they do a refinance and don't have to worry about, flipping or anything like that. So our bridge loans today we're going to talk about are very unique. We are the only bridge lender that cross collateralizes in multiple states, and there are a few other companies out there that offer bridge loans. A lot of them are really offering a bridge, they're taking some equity from a borrower's current home to give them enough for down payment and closing costs, and then that person needs to go and qualify for a purchase money transaction on the new home. But there are a lot of challenges with that. And so the biggest one comes to, can they qualify for two mortgages, right? Fannie and Freddie have DTI restrictions. And so you saw a lot of newcomers come out in the market offering these guaranteed backup contracts or guaranteed contracts to fulfill one of the Fannie and Freddie requirements of saying, if you have your house under contract and it's non-contingent based upon financing, then we will allow you to omit your current mortgage payment from your debt to income so you can qualify for that new mortgage. And that's great for some folks, but our product eliminates the need to pay additional for a backup contract, and we're going to talk all about that. Here's the problem in the market today and going to be exacerbated when the market shifts and rates come down and more inventory comes on the market. A lot of homeowners who want to go buy a new home feel trapped. One, because they can't qualify for two mortgages, or they have to do that backup guaranteed offer and pay for it, and then try to find someone else to buy their home for a higher amount, or they get stuck with accepting a low ball offer on their home. Many folks don't want to move twice, right? In this market, if they put their home on the market before finding a new one, chances are they'll probably sell it. And then they'll have to go move to temporary housing somewhere, maybe move all other things into storage, then go find a new home, then move again, get their stuff out of storage, and it become cumbersome, anxious, and costly. And then the last challenge that a lot of folks have is if they've been in their home for more than 5 years, and a lot of folks have been in there 10, 15, 20, some even 30 years, they need to get out of that home first. They need to vacate it. They need to touch it up, do some minor renovations, maybe professionally stage it so they can maximize the sales price and not feel rushed to accept an offer so they can go buy a new home. A lot of traditional lenders fall short of having a product that solves the solutions like this out in the marketplace. And a lot of bridge products are tough to find. If you're licensed in California, there are a lot of bridge loans lenders in California. And we're headquartered in California. But once you get out of California, it's tough to find something that's aggressive and solves the solution in one swoop. And that's where we come into play. And we're going to talk about that today. So let's talk about what a consumer bridge loan is. It allows homeowners to purchase a new home before selling their existing one. We do that here at Arrival Home Loans through cross-collateralization, which encumbers two properties with one mortgage note, two deeds of trust, and cross-collateralizes those together to allow for higher loan amounts. We'll explain a scenario of calculating a loan amount and how this all works in just a few moments. It's a short-term temporary financing to solve a solution to get them out of their existing home and into a new home, allows them to make a non-contingent offer based upon financing. 34% of buyers in the market are cash buyers right now. And so it's tough if you want to put in a contingent offer. Sellers are not even looking at those these days. We'll talk about an exit strategy as well, because that's one of the most important factors of an arrival bridge loan. We use the equity in the existing home and the potential equity in the new home they want to purchase for the down payment or full purchase price of the new home. So let's talk about our lending guidelines, because these are pretty cool, pretty unique, and very different from conventional financing. So listen up. There must be a primary residence or a second home purchase component to our transaction. There's one big difference of our peers right now. We do allow second homes as part of our bridge product, not investment properties. If you have an investment property purchase and you're looking for a bridge, you can still reach out to us, because remember, our parent company, Pacific Private Money, focuses in the business purpose space, and they do have investment property bridge loans available, and we can hook you up on those as well. The term is 11 months. It's a balloon after 11 months. Interest-only payments are required, and there's no prepayment penalty. There's also no EPO to our lending partners as well. We have a max CLTV of 75% for both properties when a current home exists. We're also one of the few bridge lenders that will allow you to cross-collateralize more than 2 properties. And we can talk about that in a little bit as well. We have a minimum credit score of 680, which is a little bit lower than some of our peers as well. And by allowing a maximum CLTV of 75%, that's at least 10% or more than some of our peers as well. Now, here's something that's extremely unique to Arrival Home Loans. The loan amount can be higher than the purchase price if the CLTV allows. Now, you may be scratching your head saying, wait a minute, why would somebody want to borrow more than the purchase price of the new home? Well, there's several reasons, but the 3 most common reasons are: 1, folks need money to vacate, move, renovate, and professionally stage their home so they can maximize the sales price. If the equity allows, we'll allow them to get the money to do those things so that they can sell their house for more. The second reason is, and especially in this market, they may have found a great house to buy, but it's not perfect. They want to do some minor renovations before they move in. And again, if the equity allows, we'll allow them to borrow money over and above the purchase price to do those necessary renovations. And then the last reason, which is the most common that we see, is because we technically don't have any quote unquote debt to income restrictions on our loans, and I'll talk about that in a minute as well, we will ensure that we're not putting any financial hardship on any of our borrowers by adding an interest-only mortgage payment on top of their current financial obligations, including any mortgages they may have on their current property. So if the equity allows, we will allow funds to get cash back to the borrower after funding so that they can make the interest-only payments with those additional funds and not have to worry about causing any financial burden to your borrowers. It's very unique to Arrival Home Loans. The borrower must have a viable exit plan. Because our term is only 11 months, they have to figure out a way to pay off our bridge in full within 11 months. Now, don't worry, on average, our loans are paid off in 4.5 months. Some loans are paid off before the first payment is even due. We'll talk about an exit strategy in just a few minutes. All of our loans are reduced alternative documentation requirements. This is probably the biggest differentiator from any of our peers out there in the marketplace today. Well, what does this mean? This means our products are stated income, stated asset, and no appraisal in many instances. We use internal automated valuation models to determine values. And if the values of those AVMs come in an acceptable rate to be able to provide the loan at the parameters that the borrower needs, then there are no appraisals required. Because about 15% of our loans come to us as a dumpster fire because they just got turned down last minute by a jumbo lender or a conventional lender because of many reasons, we could talk about those at another call, we got to close quickly. And so many times, out of those emergencies that come to us last minute, they already have an appraisal. If you have an appraisal that's air compliant, it can be transferred to us and we can use that as well. Now, this isn't your stated income, stated asset program, from the early 2000s before the 2008 meltdown, where you just state something that looks good and you fog a mirror and you have a high credit score and you can get the loan done. No, we want you to be open, honest, and real with the employment, the income, and the assets of the borrower, because our underwriters go to several different sites to verify the reasonableness of the income and employment that's stated, as well as the assets. And if it's unreasonable, the underwriter does reserve the right to ask for pay stubs and asset statements. And that happens in about 3% of the cases. Sometimes asset statements are needed if the borrower has an extremely high debt to income ratio. We want to make sure one of two things. Either they have liquid assets they can pull from to make the payments and not put them in financial hardship, or two, they're getting cash out of the proceeds of the transaction to be able to make the interest only payments. It's very important. Also, we want to verify earnest money and that they have the money bringing for a down payment if they're bringing a down payment. So sometimes an asset statement is asked for to make sure that they have those funds available. We do not require that their departing home be on the market or even under contract. That's another difference. The cross property can be an owner-occupied home, a second home, or even an investment property. But just remember, there's two parts of our cross collateralization. There's a departing home, which again, it can be an owner-occupied, a second home, or an investment property. It has to be residential in nature, can't be commercial, agricultural, anything like that. But the other part of the equation is the purchase. The purchase part of the equation has to be either a primary residence or a second home. All right, let's talk about the exit strategy. Because predominantly this is an equity depletion product rather than an income-driven product, we have to ensure that the borrowers have a sound plan that's reasonable to get out of this mortgage within 11 months. This is typically what you see. They sell their departing residence. They will take a portion or all of the proceeds of the sale of that departing residence, and they will pay down the balance on the bridge loan. Then the remaining balance that is only secured now on the new purchase property will be refinanced as a rate and term refinance with the loan officer that partnered with us in the bridge in the first place. Hopefully you guys have good CRM and you keep in touch with your past customers, but if you don't, not to worry. Once we receive a payoff request, or we're coming within about 120 days of the bridge expiration or balloon period, we're going to reach out to you and make sure that you know that, hey, this person just requested a payoff. You may want to call them to see if they're refinancing, and hopefully it's you that refinancing them, or that you reach out to them because they get about 4 months to pay off the bridge. They've been in it for about 7 months now, and they should be making plans to get out of that bridge. Sometimes borrowers have other assets or investments that they're going to sell or liquidate to pay off the bridge. Sometimes borrowers are coming into money in several months through an inheritance, but they don't want to wait and they want to buy a home now. Here's how the bridge loan works. We're going to go through a scenario on how you calculate a loan amount on our bridge loan, and you can see how it all comes together. So in this scenario, we have older folks, they're empty nesters, their kids are grown out of the house, they've been in this home for a long time, it's currently worth about $1 million, they've been paying on the mortgage for quite some time, they only owe $200,000 on it, and they're looking to downsize into a nicer neighborhood for $800,000. So based upon this, we determine the maximum loan amount based upon 75% maximum CLTV. So we add the value of both homes together. The $1 million departing home, the $800,000 new home. We get 1.8. Then we take 75% of both of those. That's 1.35. Now, from here, we have to subtract the first lien that currently exists on the departing home, which is $200,000. That leaves potentially a $1.15 million loan available for these folks. Now, we will sit in a second lien position on a departing home as long as we're cross-collateralizing it with a new first mortgage on a purchase, and we'll need to sit at first lien on the purchase. Not to confuse you all, but if a borrower has a free and clear departing home, sometimes we can just do a first lien cash out bridge refinance on the departing home and give them the funds to buy the new home in cash without having to cross collateralize or put a lien on that property. Now, in order to do that, we need to be in first lien position, so that home needs to be free and clear or have a significantly low mortgage balance to do that. So back to this scenario here, based upon these figures, we'd be able to lend the whole purchase price of 800,000 or more if they desired. Remember, they have 1.15 available. The purchase price is 800. Like I said, if they've been in the home a long time, they may need to do some touching up, renovating, professionally staging. They may need some money for interest-only payments if they're retired and on fixed income and they have assets that they don't want to tap into. There's a lot of flexibility in moving parts of these loans that we can accommodate for. So here are some scenarios on where our bridge loan makes sense. Buy before sell. That's the biggest, and you hear a lot of these buy before sell lenders out there, but none are as aggressive as we are. And just to let you know, we've never foreclosed on a borrower. We've never had a borrower default. We've never lost any of our investors' money. And we do not have the inability to fund loans at this point, meaning we have a lot of capital to fund a lot of loans, which unlike a lot of our peers, they run out of money in the middle of the month until they sell all their loans. You don't have to worry about that with us. Some want to make kind of a good as cash offer. A non-contingent offer with an Arrival Home Loans pre-approval competes with cash offers. Borrowers don't want to double move. Some people have down payment challenges. You know, there's record equity locked up in American homes today. Divorce or probate situations. They got to get out of the house. They want to buy a new one. They don't have the money settled from the other property just yet. And a bridge loan instead of liquidating other assets, tapping into a 401k, selling stocks or mutual funds, which may trigger capital gains and tax consequences and things like that. All right, we've got a few case studies we're going to go through. And we're going to wrap up in just a few minutes, and then I'll open it up to any questions. And I'll tell you a little bit more about the terms and parameters and rates and points and fees and all that fun stuff about our product. So I know you guys can read. I'm not going to sit here and read all through this, but I'm giving you a lot of examples on how our products worked. This jumbo consumer came to a jumbo lender for a pre-approval before the taxes were due, told him how much he was making. Tax season came and went. He didn't file his taxes, and they required tax returns. So they denied it until he filed the tax returns. Borrower came to us. We saw his P&L. We saw his returns for the previous years. We felt he would be qualified as long as he filed those taxes to get out of our loan, and he had several months to do it from the extension period. We gave him a $3 million loan, closed in 10 days, and 7 months later, he filed his taxes, qualified for 30-year jumbo, paid off our bridge months later. Move up buyers. This is typical. You know, they were planning to sell in the spring, but in the winter, they found their dream home. They were competing against other offers. They couldn't make a contingent offer. They couldn't qualify for 2 mortgages. They were in a conundrum. They came to us. We provided them a $2 million bridge so they could win the offer, compete, and get the purchase. They did that. Several months later, they sold their home, paid down the bridge, and then refinanced into a longer-term mortgage debt with the loan officer who partnered with us on the initial transaction. Here's one where the borrower had a tax lien pop up on their credit report, but it was in error. However, the conventional lender wouldn't approve the loan until the tax lien got removed from the credit report. They came to us in despair. Due to the subjectivity allowed in our underwriting process, we looked at some documentation. We believe that the tax lien was an error and that it would be cleared up, but you know the IRS and the bureaucracy of trying to get things moving quickly with them. We gave them a $950,000 loan. A few months later, they got the tax lien cleared up, removed off their credit, and were able to find a long-term mortgage debt and pay off our bridge. Here's an example of a multi-state cross-collateralization. They lived in California, found new construction that they loved in Arizona. The builder said, we won't accept a contingent offer, and so they were stuck. They came to us. We gave them a bridge. We secured a lien on their departing home in California, as well as the new purchase in Arizona. And they didn't have to wait or have the weight on them of selling first. 6 months later, they sold their home, pay down the bridge, and then refinance into a longer term mortgage strategy. So you can kind of get the hint here. I'm going to skip over this next buy before sell here, but I'll keep it up long enough so that when I send the recording to everybody, they can kind of read it if they would like to. So you can see our product is great for the real estate industry, brokers, and agents because it can get potential future buyers off the sidelines today and into the market today to buy today, give them faster closings, more closings, a differentiated product offering, and additional lead sources. If you're a loan officer and you work with realtors, this is one of the most powerful tools that you can have in your belt to talk about with a realtor. If a realtor has a pipeline of potential future buyers, this is the solution to unlocking that pipeline today. It's great for lenders and builders because it gives you more qualified buyers, a new lending product to talk about that's very easy and hassle-free, quick approvals, less fallout. And it's great for homeowners because it gets them unstuck. We have competitive offers, get them a higher sales price on their current home by being able to vacate and get it done, ready for sale on their time and not feeling rushed or hurried. Lower payments because they're interest only without having to sell first. And then, of course, moving once and a faster closing time. I'm going to skip over our AEs and kind of our operational executives that we'll get into once you form a partnership with us. We do have a third-party origination website, and you can request logins once we have a partnership. It's very easy. We'll send you your login credentials once you request them, along with the third-party origination training manual, and your AE will be assigned to you, and they can help you upload documents into the portal. Very easy to use. We don't need a ton of documentation from you to get loans going. And this is kind of how the process moves, but until you have a loan with us, it really doesn't make sense to get too in-depth into these things here. So I appreciate you guys taking the time to join us today. We do have several minutes left. I am going to kind of talk a little bit more about interest rates, products, fees, and things like that. And then I'll turn it over for anybody to ask any questions. And if you're potentially automatically muted, you can post your question in the meeting chat in just a minute. So, what are your interest rates? Well, it depends. It depends on the credit score, the loan to value, the loan amount, and the occupancy. There is a bump for second homes as compared to primary residences. But our rates range from the mid-10s to the 12s. And so it really kind of depends. Our average interest rate, looking at our pipeline over the last several months, is 10.875. Remember, they're interest-only payments, there's no prepayment penalty, and we don't require a certain amount of months of interest to be paid before they can pay it off. So interest rate really isn't that big of a deal because they're not going to have this loan for a very long time. Now, what are the points? So typically, our transactions from a partnership perspective are structured at 2.5 points charged to the borrower as a borrower paid fee. Out of those 2.5 points, we typically pay our lending partner 1 point out of those. We retain 1.5. We have a $24.95 underwriting fee, and we allow our wholesale partner to charge up to a $695 processing fee. We do follow TRID, so we have our RESPA waiting periods and timelines. We do disclose full packages, including an LE. We do disclose the CD as well. And we underwrite and control all the funds internally here. We don't outsource anything. Arrival is the lender. We underwrite and do everything internally in-house. We do have outside investors we sell the loans to, and we also have pools of investment funds that we can tap into as well. So let me turn it over to you guys to answer any questions that you may have for me. But before I do, I forgot one last thing that's really important. Because of the nature of the product and because of the points and fees and the interest rates, all of our mortgages are considered high-cost home loans, Section 32. Because of that, all borrowers are required to go through a high-cost home loan counseling session. They can choose whoever they want, but we have a few preferred providers that will share after we disclose. That housing counseling needs to be done after the initial LE is disclosed to them and before the initial CD goes out, because there's an additional 3-day waiting period after they get their HUD certificate. We've never had a borrower cancel or back out of a transaction because they had to go through this home loan counseling. The type of borrowers that our product is for, they know what they're getting into. We do a great job explaining it. They understand the nature of the product and why they have to do what they do.